Hi, I'm Bob Graham. I've been following the insurance industry since 1999, and I'm thrilled today to get to talk to Rodger Bayne, who I know as an expert in the insurance industry because I met him he was a source for me when I was working for some insurance newspapers. And this sounds like blatant overstatement, but it's really not. Roger's one of the few people who could read the tea leaves and tell us what was going on in the insurance industry before it happened. And he's very reluctant to admit that, but he was actually a really good source for me. And several times we wrote stories because he was able to tell us what was going to happen. And he is a very insightful guy when it comes to the insurance industry. I think you're going to like what we're about to talk about. So, Roger, why don't you start off first? We're talking to small business owners about their insurance needs. Set the stage for us. Can you do that?
Wow, that's a big stage, Bob. Let's see what we can do. You know, in the insurance world for small business, one of the biggest challenges we have is that any business, when you look at their overhead items, first is payroll and human resources. You've got to have people. But the number two business overhead expense is health benefits. Employee benefits, the primary of which is health insurance. And unfortunately, health insurance is out of control. So if you want to stage the set, that's really the stage. We're dealing with an out of control number two overhead expense. And the only way for a small business to win, to be successful, to start generating profits is to overcome one of those burdens or a burden like that and be able to do a better job. For every dollar they save, it's profit. And for every dollar of profit, that means they had to do $10 worth of work or $100 worth of work, depending on the profit margin for that particular business. So, really, what we're talking about today is this game of business and how to get control, because that's what every small business owner wants. That's why we're in business.
Okay, so I am a small business owner. I have a company of one, so I am not the likely audience you were looking for. But first of all, can you describe to us what you mean when you describe small business? How many employees that is?
Wow. Well, that's a question I get all the time. And everybody has a different definition for small business. But what I can tell you is that I've been working with businesses from 5 to 200 employees for many, many years. Some businesses, some people will consider themselves small, even at 3 or 400 employees, depending on the industry that they're in. But for the most part, let's say 15 to 150 employees fits into a really good niche of what I would call small business. When you're below 15, that's really small, but still at 5 employees and above, you've got to find better ways to attack it. Sole proprietors, small firms with 1 or 2 employees, their solutions are cut and dry. It's either a small group plan or it's an individual plan. As you get larger, you have many more opportunities.
Oh, wait a second. You're saying there are many more opportunities? I thought we had a choice of choosing one of the big carriers or going on the exchange, just not offering our employees any coverage, taking the penalty, and moving on. You mean there are
Well,
options?
interestingly enough, when I got into the business back in 1987, we had a lot more players. In fact, as a health insurance broker in 1990, I got over 40 1099s, meaning I had business on the books with over 40 different companies, and the bulk of them,
Insurance
the
companies
bulk
paying
of
you a
them,
commission.
right, and the
Okay.
bulk of those were health insurance companies paying me commissions for business that we had put in force for them. Today, a broker is hard pressed to find more than four of those plain vanilla characters in a particular marketplace, meaning those insurance carriers. We in the industry call them the BUCAs: Blues, United, Cigna, and Aetna. Right? That's the big
Bu-
four.
be-
BUCA, B-U-C-A.
That is a new
Right?
one. See,
So,
this is why I like talking to
so,
Roger.
so most brokers will know the BUCAs and not really go beyond that because they really don't know any better. But there are new ways, other ways. They're not even new, really. I've been doing them for 30 years. But there are other ways to own your own health plan, to build it with insurance that protects you as an employer and really drive better results.
Wait a second. You said own your own health plan. Are you suggesting that small businesses should own their own health plan? How would they possibly be able to manage that in addition to running their business?
Well, see, that's easy because just like they hire somebody to run different elements of their business, they would hire someone else to run their health plan. Right now, they do that in a way. They give thousands and thousands of dollars to the insurance company every year and say, do the best you can. But they're not looking for results. They're not looking for any of their money back if they don't spend it. If they don't spend it, if they have a group that runs really well, never sees the doctor, that money's still gone. When you're on your own health plan, if you don't spend it, you keep it. It's that simple. And so there are ways to do that now in such a conservative fashion that even the smallest of businesses can do it. In some states, we have carriers that will do it down to 2 employees. 5 is a number that's more common, but from 5 employees and up, owning your own health plan many times can be the best option.
That just sounds scary to me, Roger. Can you talk about how that actually goes? I know you gave some of it, but if I'm a small business owner, you've given me something I could never deal with.
Let me tell you, actually, it's a lot easier to deal with than you think. Let's talk about the conventional group insurance program for a minute. The employer is really a facilitator of a contract. They negotiate with one of the BUCAs, they pay a premium with partly their money, partly payroll deduction from their employees. They pay that money in, and the insurance company has only one obligation, and it's not to the employer. That obligation is to the employee.
Okay.
And it's made an insurance certificate, right? It promises to pay benefits. Here's what we pay. If you have a doctor's visit, if you have an office visit, if you have a hospital stay, this is what you're paid. And that promise is made between that insurance carrier and the employee. And that's the deal. So the employer's kind of out of it, except for whatever regulatory obligations he has to maintain the plan, right?
Mm-hmm.
When you step to the other side where you want to own your own health plan, the employer says, I'll make that promise to pay benefits to the employees, and then I'm going to buy all of the insurance that I need to protect myself from that promise. The difference is you're buying insurance to protect yourself. It's a much smaller cost of insurance for you, and then the rest is in the cost of benefits, but if you don't spend it, you keep it.
Okay.
That's the deal. Plenty of insurance involved. You have to have insurance. Today, with medical claims soaring through the roof, you can't possibly figure on establishing a health plan and not buying some insurance. But who are you going to protect with that insurance?
Okay. And you've been doing this for a while, so you know how this works, and this works smoothly, and it's legal.
Yeah,
there are no violations of state laws or federal laws. It doesn't circumvent the ACA or any of that.
It's all completely legal. It's been legal for a long time. I sold my first self-funded plan to a group of around 25 employees back in 1988. Might even have been 87. So 87, 88. And I've been doing it ever since. And in doing that type of program for this many years, the programs have evolved and gotten better and better. They've gotten more conservative, more protective, giving more protection to the owner of the business so that he can comfortably do this. All the paperwork, all the work, all the billing, ID cards, it's all done for them. And business owners aren't going into the insurance business. They're simply owning their plan and having somebody run it. And because of that, they get to keep what doesn't get spent.
Okay. And so how do the benefits for the employees differ if I'm using a BUCA versus a self-funded plan?
Here's where the good news is. In the fully insured world, this BUCA world where you have the insurance carriers under state regulations offering these health benefit plans, through the exchange, off the exchange, really doesn't matter. In that world, you have state regulations that are telling you exactly what you must cover, what you can't exclude, and in some cases, even how much of it you have to cover, right?
Okay.
In the world of ownership, where you own your own health plan, in that world of self-funded benefit plans, that scenario means you're regulated under federal guidelines, and the federal guidelines give you much more latitude in how you design and build your benefits. Now, what that means to me is you get better benefits for the dollar. They might be slightly different in some regards, but those differences are to the advantage of the employer population and their employees. Most people, instead of having a state say hair transplants must be covered, they would much rather have that money going to lower deductibles, lower copays, or lower cost for their employees. And so when you design your own health plan, you can take a look at those things, make sure you're covering what you want to cover at a better way than what you're being provided under these regulations that are undauntingly overbearing in all 50 states now.
How do employees react when you set up this type of plan? Do you see friction from them, or do they actually see the benefits? And
We rarely ever see any friction from an employee, no more than we would see in a fully insured plan, right? There's always friction from an employee. The one thing I've learned after 32 years of selling health employee benefits, employees demand the best benefits their boss's money can buy. But when it's their money, they buy the cheapest thing on the table.
okay,
So keep that in mind. When an employee demands best benefits and then is given a choice of A or B, B being less expensive, A being this rich benefit that he's demanding, and he pays the difference in the cost, he buys the cheaper one. 80% of the time. That's a real number. That's history. 30 years of doing that. I've had challenges with employers where they said, no way, all of my employees will buy the best benefit. I said, no, they won't. This is white collar, high end computer programming in the medical side of the world. And 80% of their employees bought down. Only 2 bought up. In fact, it was way more than 80%. Only 2 bought up, and that's because in this particular case, they were out of state. They wanted to do that for a different reason. So when you look at this thing, you have to know that the employee population would prefer choice over a mandate from their employer that this is what we have.
so if I own my own health insurance policy or program and I'm a small business owner, I can still provide my employees choices. It's not a here it is, take it or leave it.
Yes, in fact, in many cases, you can offer them more choices than they're allowed to in that other market, right? I typically say 3 or 4 health benefit plans is a great option. So if you can go to your employee population and establish what we would call a defined benefit program, or a defined contribution program, the employer can now establish a budget. Say, I have X number of dollars per employee per month that I can commit to health insurance. And then he can lay that budget out, and we can then tailor 4 different benefit plans, one of which is almost entirely paid for with that budget. And then the other plans for the employee options, they pay a little more if they want to buy up to them. This gives the employee that freedom of choice, that flexibility, that ability to say, all right, what do I really need for my family and what should I be paying for it? And in this scenario, you'll find out most of them buy the least expensive plan. That's because they become shoppers now. They think about their actual utilization of their healthcare costs, what they're spending, how they're going to manage this thing, and that's what they do.
They have skin in the game.
They have skin in the game.
Which is good for the employer.
It's good for the employer. It's good for everybody because it keeps a consciousness of what's really going on in healthcare spending. You know, one of the problems in our healthcare market is that somebody else is always paying the bill.
Okay.
Right? I mean, always. Senator Graham came to Baltimore in 1988.
No relation to me.
No. Senator Graham came to Baltimore in 1988, and he said, if every time I went to the grocery store, somebody else was paying 80% of the bill, I'd shop differently. I'd eat a lot better, and so would my dog. Right? So this is the problem when you're spending somebody else's money. American employees, Americans in general, don't shop for health care. They shop for health insurance. And then once they bought it, they think healthcare is free.
Right.
That's a problem because they demand the best. They want to get the best. They don't even want to look at a generic alternative to a prescription when a generic alternative to a prescription is identical to the brand name and a third of the cost and sometimes a tenth of the cost. So we have to understand what's going on in this overhead segment in order to win.
Okay. Now, before we got started, you gave me, and I didn't write it down, a startling statistic about how much money comes back to the employer when they do this own your own health plan per employee per year on average.
Well,
am I getting that right? I didn't write it down, but it was,
okay.
I was so shocked.
First of all, I can tell you this. It varies by product, and there's a lot more products out there than there used to be. I could deliver today probably 8 or 9 different companies, literally hundreds of different benefit designs, all in this other model, away from the BUCAs into something that you get to own your own plan in a self-funded marketplace.
And they're competitive in that landscape.
Well, and they are
so,
competitive.
right?
And here's the most important thing. I've never sold one of those plans if it wasn't the most competitive offer. Employers only buy it because it's the best offer at the time. And then, even after it's the best offer, the rating model and the actuarial model, these are the guys that put together the numbers and really understand what to predict on your healthcare spending. That model that I use most often yields over 68% of their employers getting some of their money back. And the average is over $600 per employee per year. Wow. So if you're one of those 68% of those employers, and let's say it's a bad year, one of 60% of employers, I mean, the reality is a very high percentage of these employers.
A bad year meaning they use a lot of the health benefits because employees have issues, right?
Well, in that statistic, I reduced 68% of employers to 60% of employers, saying a whole lot of employers spent more money than they normally do, right? So if only 60%, but if you're one of those employers that gets money back in this particular program, you're buying it because it was the best deal, and then you're still saving $600 per employee for the year based on that surplus that's left over. Now that's an average number, right? Sometimes we write a check for $240. This is your money left over in your account. Here's $240. Other times we will deliver a $36,000 check to a 25 life company. So it
now
really
the BUCAs
depends.
never send refund checks at the end of the year, correct?
Well, in the fully insured world, you can't send a refund check. The only refund check you get is the one that the federal government requires them to send if they don't spend a certain amount on claims, right? That's that rebate check under the ACA.
Okay.
That's it. So those are the kinds of things you really have to look at.
So does this work for any organization, any company, if they meet the size criteria, or are there some better or worse, or how do you figure that out?
In the world of insurance, there's always good risk and bad risk, right? What I can tell you that is pretty clear that over 70% of small employers pay more for insurance than they get back in health benefits every year. Okay. The other 30% are spending a whole lot of money, right? And they're spending a whole lot of the other guy's money, right? The 30% is spending the 70%. And in the insurance business, it's amazing in health insurance just how bad they are. I was at a seminar the other day for one of the big BUCA companies, and they made it very clear that half of all of their claims are incurred by 4% of their population.
Wait, hold on. Go through that again. You lost me.
Means in this big carrier, dominant in the state, they said 4% of the people they cover spend over 50% of the claims dollars.
They're the really sick people.
They're the ones that are really spending the money. Okay? When you climb up to 10% of their people, you get to the 80% claims number.
Okay.
So that means the old 80-20 rule in health insurance is gone now. It's 10% of the people are spending 80% of the money. So those guys, we're probably not going to be able to help.
They're served better by that big carrier.
They're served better by the big carriers than massive numbers. But what about the rest of them, right? There's probably 30, 40, or 50% of small employers that absolutely deserve preferred rating in their health plan. And they can't get it in the fully insured world because the regulations no longer allow that kind of rating. But when you own your own health plan, you get rated for who you are and what you spend and what you're going to spend. And as a result of looking at that and buying insurance to protect, like, I expected to spend this, but something happened, you still have insurance for that. So we're spending some money, but we're not spending all of it. And that's the advantage.
And walk through me, if I were a small business owner and I was interested in doing this, walk me through that process, that my involvement in that process and where you do your part. Because I don't want to spend all my time, if I'm a small business owner, running an insurance plan, and it sounds like someone's got to do that.
Well, it's kind of interesting that you say that, but what we do today is we marry all of those components together. We design, we build, and we do it. And in fact, the BUCAs are even coming into this game because they see the pressures to do a better job for their customers. So now we see a couple of those BUCAs actually three, sometimes all four of them, designing programs where the employer can own that product. Okay? So we do that kind of thing, but we go expanded. We go into more markets and more. The advantage is that typically the people that run these health plans for a small employer are more efficient than the big guys, right? Think of the overhead of the big guys, right? What does a CEO of a health corporation make nowadays, right? A huge, huge money. I think I saw in the news just the other day, $4.5 million a year is the average health plan CEO. So when you look at that kind of money being paid, you've got big overhead numbers, right? Most of the companies that are building in this self-funded world are lined a whole different way, right?
Okay.
And so you're driving with a very efficient administrator or third-party administrator, as the industry calls it. The third-party administrator is integral component. They're the guys that run the health plan for you.
Okay.
So a small employer isn't going to say, here's your ID card, employee, and it's got my name on it. Call me if you have a claim. The small employer says, here's your ID card from this firm. And this firm handles customer service, billing, enrollment, eligibility, claims payment, processing. All the things that go to running a health plan are handled by this administrative department.
Okay.
And then you buy insurance in case claims get ugly. And then the rest is a claims fund. And all of that money in the claims fund, again, the most important thing is if you don't spend it, you get it back.
Okay.
So that's really what it's all about. You're not handling health insurance. I'm not asking a small business man or woman to go into the health insurance business.
Okay. I'm glad we're clear about that.
I'm just asking them to buy insurance a different way. And by buying insurance to protect yourself as the employer, instead of having the insurance company buy coverage to protect your employees directly, you gain control.
Okay.
Not only control, but when's the last time you asked your health insurance company how much they had to pay for you last year? And you can't get an answer. In our programs, you have full transparency. You know where your money's going. Most small employers appreciate that because, frankly, we're in business to drive results. And we want to know where our money's going. And in the insurance world, all too often, we don't know.
Okay.
In our programs, you'll get monthly claims reports. So you'll know where your money's going every month. And that doesn't mean you're going to know who's sick and who's got what and any of that, but you're going to know where your dollars are going. And that's what's most important to employers. They want to know that their money is spent appropriately and prudently. And they want to know that their insurance company didn't make $100,000 off of them when they should be making 10.
Okay.
And so that's really what we're looking at, is getting better control, better transparency, and oftentimes better benefits for less money.
Okay.
In fact, most of the time, better benefits for less money because they're not going to buy it otherwise.
Makes sense. So what's the next step? If I'm a small business owner and I've heard this and I'm intrigued, what's the next step for me to?
Well, let's talk about that. We said a moment ago that not everybody should be there, right? So the next step is real easy. Let's find out if you're one of those groups that should be. And our firm has pioneered what we call a group risk assessment. And through that group risk assessment, we'll set up a customized web portal for all of your employees to go out and answer some questions, fill out the information. It'll all come back to us through a secure website so we can do this group risk assessment. We're going to tell the employer a really good demographic breakdown, the body mass index for the group compared to the national averages, their smoking percentage compared to the national averages, health conditions that are current and historic, as well as prescription drug utilization. And even a projection on costs for that prescription drug utilization. So what we're getting to is giving the employer some real insights. You know, in the old days, you used to do a whole lot of paperwork to go apply for insurance. And what you got back was a yes, a no, or a new number. No explanation, no idea why. Well, now we give you the yes, the no, a new number, and here's why. Right? You have 17 employees, and 15 of them have high blood pressure, and 3 of them have high blood pressure, diabetes, and obesity. And that comorbidity in a small group, believe it or not, that's a ticking time bomb. If you have more than one condition, the claims expectancy doubles or multiplies even greater than that. So if you have high blood pressure, diabetes, especially if it's not well controlled, and obesity, those 3 might mean a 15-life employer should not be self-funded. It's that crazy because
But
today's,
clear.
and that's that clear. The risk is there. So what we need to do is find out what risk is there. Stop flying blind, stop guessing, and let's do the analysis. Because here's the great news. Even if we find out bad things, now we're empowered to try and fix them. Right? We can't fix everything.
Right.
But we have done studies sometimes where we find a group that has 56% of their population with high blood pressure.
Wow.
Well, that's insane. And we can fix that with consumer education, employee worksite posters and classes, and go across the street and get the chili dog stand to sell turkey dogs for a while. Anything we can do to bring this stuff back in through awareness so we can actually rehabilitate groups once we're empowered with knowledge. If we don't have that knowledge, we've got nothing. We're just continuing to guess. And in that case, you might as well throw your money to the insurance company, say, do the best you can, and tell me how much more I owe you next year.
Okay, and so you're with them every step of the way with this group risk analysis, and then giving them recommendations on how they should best proceed. You're also trying to bring in the right plan options for them. So it's
Right.
not like you give them a list I picture a Chinese menu.
Not only that, no, it's actually going to work even better than that, because first of all, we're going to work with their broker.
Okay.
We're not looking to replace their broker. Now, if they need a new broker, we'll find them one. But we're not looking to replace their broker. Okay? We're friends with those guys. So the reality is we're going to help the broker through this process and the employer through this process. And simultaneous with doing the group risk assessment and collecting all of this demographic information, we've collected information. And so we can shop simultaneously the entire marketplace. But this time we're shopping with information that makes us able to get the insurance companies fighting one another for your business.
Okay.
Right? Isn't it about time they try and compete for your business in something other than plain vanilla generic rates that are come out of the state? Right? What we're going to do is we're going to give them the opportunity to compete and fight over you by giving them the information of what we really have. So the best groups get the best rates. And any group that's a preferred rate is going to likely do better than they do in the fully insured.
Okay.
Now, there's a difference to that. There's a caveat to that. Sometimes, because of the community rating rules in the fully insured world, right? Community rates mean we can only charge here and here, which means we suppress the rates for older populations and we increase the rates for the younger populations, and we come up here. In that scenario, if your group is all 62 years old, you might get better protection because of that community rate than you would going out and having them being actually rated for their cost. Their projected cost would be much higher than a rate that suppresses that.
Okay.
And so there are times when a group finds out they're better off right where they are in the fully insured marketplace. But there is also almost half of the time when the group should be self-funded. So you're looking at some really big differences in what you're talking about.
And the majorities of employers have no idea at this point.
Well, I can't say that. I would say the majority of small employers don't really know. But the thing to remember is that 60% of working Americans are covered by the exact type of plan I'm suggesting.
Okay.
Over 60% of us are covered.
The employer owns it, you mean?
Right.
Okay.
60% of our working population is covered by self-funded health plans where the employer owns that plan.
Okay.
And the reality is that many employers just don't know about it in the smaller segment. But that's changing pretty rapidly.
Okay. So what's the next step for someone if they're interested in finding out through this group risk analysis if they fit and if they have an option to get cheaper insurance through you and better coverage?
Here's where my challenge is. I would normally say, ask your broker. Right? But if your broker hasn't discussed this with you already, you might have a problem.
Okay.
Right? Because this has been going on for years. I've been delivering these health plans for 20 years. I've been talking to brokers about them, educating, lecturing, seminars, credits for their licensing, all of those things for over 25 years, actually. And so some brokers simply don't want to do it. And unfortunately, there's a couple of reasons. Might be money, It might be big bonuses paid by the bukas to keep your business there. It might be too much work. And so if your broker hasn't already discussed it with you, my concern would be why? So the next question is, do you need another broker? Or do you want to work with your current broker? But why not first call us? Let's find out the process. We'll work with your broker, or we'll find you a new one, whatever you decide. But let's get into the process first. Let's analyze what you're doing. Let's get a good handle on it. And then we're going to be able to give you some direction, you and your broker, direction that really helps you determine a long-term benefit strategy that's going to work better for your company.
Okay. And I can sort of expand on what you're saying. I was talking to a broker that's been to a number of your seminars a couple of weeks ago, and he was telling me that it's too complicated. And he keeps going, and he says, you're brilliant, and you've got a really great operation, but it's too complicated for him. And I said, well, maybe you want to talk through that with them. And as I understand it, they work with you. Is that a sentiment that you hear, or are you insulated from that?
I'm certainly, I will tell you that there aren't too many brokers that will admit something is too complicated for them. Not to me.
Okay.
They like to be the expert, even though not all, sometimes they're not, right? And they might be an expert in certain elements of the field, but not an expert in the self-funded side of the field. And so brokers can have a lot of dispositions. I've had some brokers in the same self-funded class for 25 years and still asking the same questions. I've had other brokers that we've trained and up and have become very, very successful selling those plans right along with the rest of their portfolio. And so it really depends on the marketplace. But I would tell you that typically only the top 5% of health insurance brokers are really embrace a total package job for their client.
Okay.
For example, I'll tell you this is so clear. Any of the small employers that we talk to that have had a plan that's outside of community rating, even inside of community rating, but outside of community rating especially, and the brokers will often say, hey, they got a 2% renewal, they're staying put. They're staying right where they are. Well, if you got a 2% renewal in this market, in this day and age, you made the insurance company way too much money.
Okay.
And you should be self-funded. You should be doing exactly what we're talking about today. Why isn't the broker going there? Well, because he's got 150 other accounts to renew this quarter. And yours is really easy because you seem real happy with a flat increase. So you stay put and he can move on to the guys that are problem cases.
Okay.
And that's a shame. But the reality is part of that's not the broker's fault. Part of that is the ACA's fault. They've compressed all the business into the last quarter of the year. They've made it more complicated. They've tied our hands with rules and regulations and paperwork. And so it's harder today. And what I'm suggesting does take a little more work on the broker side than what they do in that just renew what you have because it's a great renewal. Well, great renewal means you should be making the profit in that case, not the insurance company.
Okay. Now, one way we can look at these own your own health plan for an employer is the retention year to year. Do you have any numbers on how many people shift over to it and stay at that long
Our
term?
retention numbers are typically well over 90%.
Okay, so they're happy.
Stay long term, yeah.
Okay.
Yeah, I mean, I've had employers that have been in a program like I'm discussing for 20 years at a time.
Okay.
And every once in a while you'll see one move for some reason or another, or if they downsize, they get to a smaller size, or who knows what the reasons are. But typically a very small percentage that leave and go back.
Okay, because you wouldn't want to go through this for a year and then go, oh, this was horrible, and go back. So it doesn't sound like you're experiencing that.
No, I'm not experiencing that at all.
Okay.
3-4 years is a pretty typical lifespan within the same carrier, the same package. Now, they might move to another one, but they're not moving back to fully insured. They might move to another self-funded option. They might look for a little bit better customer service, a little bit better network. Sometimes we get rid of the networks altogether because the prices are going crazy in the networks too.
And are you looking at this competitive climate every year with these employers? Is that so? Year one, I'm with A,
We're
B, C company, and year two, I might move to another because it's more competitive. Or
absolutely we're looking every day at the competitive stature.
okay,
Now, for each employer, it's an annual decision. You're not going to look to move within a year.
no,
But each year, when that renewal comes up, we're doing the same exact process. We're going to do a group risk analysis. We're going to take a look at the population of employees, and we're going to know where they should be. That's the value of it. I mean, if you don't know what you have on your team, you don't know how to coach them, and you don't know how to manage them. So you need to know your assets in order to get the best strategy on the field.
you brought up the game analogy, and you were telling me earlier that you've put together a game plan. Can you walk us through that? Now, isn't it something that you can provide to people too?
Well, yeah, we can provide an outline of the game plan, an overview of what exactly we do, but it's really kind of simple. And we've already talked about it to some extent today, right? The game plan is first to know your team,
Okay.
right? Any good coach that wants to win a game has to know what his personnel are, right? You can't understand how to win if you don't know what your assets are.
Can you tell he played football?
It's the nature of the beast, right? And so when you look at your team, you will begin to understand where your strengths are and where your weaknesses are. And then you can manage to that.
Okay.
So the very first step is to get that comfort level, right? You have to know your team. And to know your team, we'd start with the group risk assessment, right? Let's do this portal. Let's get the information in.
Employees don't mind that at all, providing that information?
99 out of 100 employees don't mind that. And every
Okay.
once in a while, you'll get one employee that screams something about the privacy rules, and he'll be completely wrong, right? Because an employer that builds their own health plan has a complete right to know what he's covering.
But
right?
they
So-
don't know employee X has this condition,
we-
right?
we-
It's more aggregated, if I understand
Our
correctly,
report
right?
is going to be aggregated. We're not going to say Billy Bob has a kidney failure. We're just going to say, hey, here's your group population. These are the risks and concerns that we see, and let's see what we can do about fixing it or whether we have a better option for you. But the point is, every once in a while, an employee thinks he has some privacy right that he really doesn't. And he has a right for this information to be held confidently and privately.
Mhm.
But the employer has a right to use that in making a business decision, like how to buy health benefits, right? And that's an important thing that the employer has to know is that you're putting up a lot of money every year for benefits. You have a right to know how that money is being spent and what might happen. And
Okay.
so this risk analysis doesn't breach any of the privacy rules or laws. It's designed to give you the tools you need to drive a better plan. And that is good for your employees. It's not bad. It's not a bad thing. Employees need to know that. They don't always see that, but most often they do. So we rarely really have that concern. I bring it up because it might happen, but it doesn't happen often.
Okay.
So we do that group risk analysis. And as we're preparing that report for the employer to show them what it shows, we're also pitting the insurance companies against one another to fight for the business.
Okay.
Okay? So if that group is really good, you're going to have a bunch of people competing for it. And we're going to help drive that to the very best plan for the best rate. All right? And then once we do that, it's plan selection. You know, what plans do you want to offer your employee population? High deductible, low deductible, somewhere in between. The one thing that's really encouraging and really comforting to me in what I do is that more often than not, I deliver better benefit plans, lower deductibles, lower co-payments, lower cost sharing to an employee population than what they're buying under the ACA regs today.
Okay. Wow.
And so that's really nice. We get to go back towards some of the old-fashioned benefits. In fact, our top seller is the same top seller we had in 1992.
Okay.
Okay, it's a
So you've been doing this for a while.
yeah, it's a very similar plan. It's got really rich copays and it's got $1,000 deductible. And most
Wow.
guys aren't getting $1,000
No.
deductible anymore. So there's some really nice things about what we do in our business that helps employers get back to old-fashioned benefits that employees actually appreciate. Instead of saying, wait a minute, I got to pay how much per pay? And I have a $6,000 deductible, which I'll never spend, so I'll get no benefit out of this much money. It's a big challenge, right? Employees are sick of it, and so are employers. Nobody likes it.
I would think it hurts morale. It hurts that whole retention and
It
everything.
really does. It hurts morale, it hurts retention, and that's the other part of this whole thing. If you're going to win a game, you better keep your best people.
Right.
Your best people are the ones driving your profit line. And so you've got to keep those best people and keep them happy. And these alternatives are actually better at that than what we see in the other markets.
Okay. We've been talking to Rodger Bayne of Benefit Indemnity Corporation about owning your own health insurance plan. And Rodger's been nice enough, he agreed beforehand, that if you want to talk to him about this more, you can actually call him directly at 443-275-7412. That's his direct line. That's the number I call when I need to talk to him. And he'll actually talk to you about how this might fit for you. He'll answer your questions. He'll basically try to help you get the best benefit options for your employees. I've known Rodger for a long time, and he does not say things that he doesn't mean. And he's nodding here saying that he will take those phone calls. So let me give that number one more time.
Wait. Not only will I take those calls, but remember, I'm not looking to displace your broker. Just give me a call. Let's have a conversation about where you are. You can share with me who your broker is. I'll tell you what experience I may or may not have with him if he's in a marketplace where we do business. And if it's in a new marketplace for us, I may not even know that broker. But in any event, we'll be able to help work with your broker. And like I said, sometimes you'll find out you need another broker. And when that time comes, we'll help you navigate that playing field as well. But in any event, just call me, 443-275-7412. We can figure out the best way to start, whether it's with your broker or directly into the group risk assessment. Either way, doesn't matter. Let's just get the job done.
Great. Well, thank you so much. This has been an enlightening discussion for me. I hope it's been enlightening for you, and we look forward to talking to you again.
Thanks, Bob.
Thank you.
Take care.